Hi, welcome back to the channel. I'm Suzanne with Arvabell. In this video, we're going to talk about when you should start investing and also what to do if you don't have a lot of money to start with, what brokerages to use, and we'll also go over some of the things that you can invest in both in the stock market and outside of the stock market. First of all, if you don't know anything about managing your money or about investing, that is okay, and you are not behind and you are not stupid for not knowing it. It's not taught in schools, so unless you had someone at home teaching it to you, there's no way that you are expected to already know or have learned any of this. But that is what this channel is for, making personal finance more accessible and easier to understand. So if you're not subscribed already, consider subscribing, give this video a like, and we'll jump right into it. Just as a disclaimer, I have to say these are my opinions. I'm not a financial advisor. Take my opinions with a grain of salt. Do your due diligence, do your research, because ultimately your investments are your decision and you shouldn't be making your decisions based off of what random people on the internet are saying. The first question is, when should I start investing? And no matter what age you are, the answer to that is now. It's so important to start investing early. When you start investing early, you give yourself less time to suffer from what we call analysis paralysis, which is basically just being bombarded with all of this information, trying to analyze everything, but never actually doing anything. Because you can sit around and talk about investments and read about investments all day, but at the end of the day, actually investing is what causes your investments to grow. And if you never get into the habit of investing, you never will. When you start investing early, you have compound interest working on your side. So using easy numbers, if you start out with $100 and you earn 10% interest on that in a year, you have $110. So starting the second year with that $110, you now earn $11. And it continues like that year after year. So no matter what your age is right now, $100 now is going to be worth more than $100 5 years down the road because you have that extra compound interest working for you. By starting early, you also give yourself more time to learn and make mistakes because you will make mistakes, but you will also learn from them. You have a higher risk tolerance earlier on because you have that much more time to recover from your mistakes. You can also make riskier investments now than when you're 50 or 60 and approaching retirement. It also takes a lot of time to become comfortable with the stock market because it's a lot of terms, a lot of analyzing, and just a lot of information to take in. And if you're investing for the very first time, you're not always going to know what's going on, and that's okay. What's important is that you jump in and you allow yourself to have that time and to have that opportunity to learn about it. You're also going to encounter an emotional aspect to investing that takes a while to adjust to. Whether we like it or not, some of our emotions are tied to our money. And seeing gains or losses in your portfolio can trigger these emotional reactions that you have to learn how to control. Because if you are letting your emotions control your investing decisions, you're going to be panic selling or you're going to be holding on to false hope. And those are natural responses that everyone will experience at some point, but it's best to start investing early so that you can figure all of this out, because actually investing your own hard-earned money is a lot different than just reading about it or watching YouTube videos about it. You're going to learn the most from actually doing it. You can push it off until you have more money, but you're probably going to find yourself in the situation of always thinking that you need more money than you currently have to start investing. So you need to just get into the habit of investing now. And in order to do that, you truly need to start paying yourself first. Obviously, food, shelter, all your necessities, take care of those, but start paying yourself, start paying your retirement accounts and your investment accounts as if they're a bill and as if they are a necessity. Because in order to build yourself a better financial future, they are a necessity. If you want to start investing with a small amount of money, there are a couple of good brokerages, M1 Finance and Robinhood, and I will leave affiliate links to those in the description box down below if you want to use them. So Robinhood is totally free to use. They have no account minimums and no commission fees, which are fees that you would normally pay whenever you buy or sell a stock. M1 Finance also has no commission fees. They do have a $100 account minimum, but they have a unique thing about them, fractional shares, which I will talk about a little bit later. So personally, I think that it's good to start investing some amount of money, even if it's small, just to start developing that habit. But a lot of people watching this video are going to be like, I don't have any money at all. I'm living paycheck to paycheck. What do I do? And if that's the case, you really need to sit down and evaluate your entire financial situation as a whole. If you are living paycheck to paycheck, that means that your income is at the same level as your spending. So you gotta change something to make it work, right? So you have two options. You can either get more money coming in or cut your expenses. And for most people, cutting expenses is going to be the easiest option. But if you're in a tight situation, you may have to do a little bit of both to make it work. Now, if you are successfully able to raise your income, but you aren't noticing any extra money at the end of the month, figure out what is causing that. Are you living below your means, or are you inflating your lifestyle to match the level of your income? When you get money coming in, are you going and buying new clothes, or are you going out and drinking with friends every night? Are you treating yourself too much or too often? And if you are, stop it. And again, that goes back to paying yourself first. Instead of spending and then investing what's left over, invest first and then you can spend whatever's left. Once you can train yourself to flip those two things, you will see a big difference in your spending habits. Now, if you're like, I can't cut anything from my expenses, that may be the case, but there are probably areas where you can still cut back. Are you truly aware of what you're spending, or do you get your bank statements and your credit card bills at the end of the month and you go, whoops, I don't know how that happened? Because if that is happening to you month after month, something needs to change. Off the top of your head, how much money do you have coming in every month, and how much money do you have going out every month? If you do not know those two numbers, you are in trouble. You need to start tracking your expenses. Are you ignoring high interest debt that you have, and are you allowing those debts to stack up? If you are, you may want to assess your debts before you start investing. In the stock market, even if you are making really good returns, if you have credit card debt and car loans that are stacking up in the background at 20-25% interest, you need to pay those off first, because those are going to be losing you money. Debt repayment is its own monster. But if you are in that situation, go and read the book Total Money Makeover by Dave Ramsey, which I will also link to in the description. I don't personally agree with every single thing that Dave Ramsey says, but he is like the king of debt repayment. So reading his book and listening to his podcasts or watching his YouTube videos will definitely set you on the right path. You also need to have an emergency fund. Most people don't even have enough savings to get them through the next paycheck, so you need to start building up that cushion in case something happens. And you need to have that money, that emergency fund, in a savings account or somewhere where it's easily accessible, but you need to not touch it unless there is truly an emergency. So now we'll get into the actual types of things that you can start investing in. The strategy for investing that Warren Buffett uses is to just buy and hold. How you can start doing that yourself is by dollar cost averaging. That basically just means that over a period of time, over a number of years, you'll keep adding to your positions in these stocks and funds that you're investing in. Sometimes you'll buy them when the price per share is high, sometimes you'll buy them when the price per share is low, but over that period of time, that cost per share is going to average out. Stocks basically are just tiny little pieces of companies. If you're interested in stock picking or really just investing in the stock market in general, I'm going to link to The Intelligent Investor down below. It's the best investing book of all time, and it is not by any means an easy breezy read, but it has great information and it's a great place to get you started. All right, so a couple of terms that you might hear are blue chip stocks and dividend paying stocks. Blue chip stocks are stocks like Coca-Cola or Disney that have proven profits and proven growth. And for that reason, they are seen as safer or lower risk investments. Blue chip stocks usually have a higher price per share. If you're wanting to buy into these, but you aren't starting out with a lot of money, M1 Finance offers fractional shares. So basically, instead of having to buy one whole share, it's exactly how it sounds. You can just buy a fraction of it. When companies make profits, they can either reinvest those profits back into their business, they can buy back their own stock, or they can pay out dividends to stockholders. If a stock offers this, it is called a dividend-paying stock. They can either give you cash dividends or stock dividends. This means that because you own their stock, because you own a tiny little piece of their company, they will either share a tiny little bit of their profit with you, or they will give you some additional shares. Just be aware that not every single stock and not every single company will pay you dividends. Penny stocks are stocks that are valued at less than $1 per share. In a future video, I will go into why exactly the share price itself does not mean that a stock is expensive or cheap, but the point that I wanted to get across is that penny stocks are highly speculative, so for long-term investments, they're probably not the best option. If you don't really like the idea of picking individual stocks, you can look into mutual funds and index funds. Both mutual funds and index funds are like baskets of assets that diversify your portfolio across a lot of different stocks, sometimes hundreds of stocks. Instead of buying a piece of one individual company, it's like you're buying even tinier pieces of a lot of different companies. Mutual funds are actively managed by fund managers, and for that reason, they usually have higher fees. ETFs are sort of similar. ETFs track a particular index, like the S&P or NASDAQ, for example. The biggest difference between an ETF and a mutual fund is that mutual funds are traded once a day at the end of the trading day. ETFs are traded intraday, so throughout the day, they are traded exactly like regular stocks. There are also bonds, futures, and Forex. I'm not going to go into those, but if you want to know what they are, feel free to Google it. There's lots of information. I also wanted to mention a few ways of investing that aren't in the stock market. Investing in businesses, real estate, and real estate investment trusts. With businesses, you can invest in startups or in existing businesses, and if you've ever heard of the show Shark Tank, that is exactly what they are doing on there. Real estate. With real estate, many millionaires and billionaires make their fortunes by owning lots of rental properties. That can be residential units, multifamily units, commercial units like office buildings or malls. And if that's something that you're interested in, I will link to the book Rich Dad, Poor Dad down below. Robert Kiyosaki uses real estate as his primary way of investing, and he's made a lot of money doing it. And this is just a great personal finance book to read all around. Real estate investment trusts. This is where instead of going out and getting rental properties yourself, you are investing into a company that already owns and operates income-producing real estate. These are usually good for people who don't necessarily want to have real estate themselves, but still want to be a little bit involved in the real estate side of investing. Starting out though, you probably won't have enough capital to be investing in other businesses or in real estate, but they're good investment strategies to know about and to set as goals and to work towards in your future if there's something that you're interested in. The last thing that I wanted to bring up is diversifying. Diversifying means spreading out your investments so that you don't have all of your eggs in one basket. If you're starting out with small amounts of money, I wouldn't worry so much about diversifying as much as building up substantial positions in companies that you really want to be a part of. You don't want to just throw money at as many random companies as you possibly can. That's just generally not a good idea, and there's no way that you'll be able to keep up with your investments. And again, if you're not comfortable stock picking, that is where you want to look further into mutual funds, index funds, and ETFs. Once you have more money, you can start worrying more about diversifying within your portfolio, as well as diversifying across different investment vehicles like real estate. If you haven't already, subscribe to the channel. The next few videos are going to go more in depth on actually trading and investing in the stock market and what that looks like. Hit the like button, visit our blog arvabell.com, follow us on Instagram, and I will see you in the next video.